lot. Welcome to Business Television India. On this special show, we tell you how to build a portfolio. I'm Hiral Desai.
A portfolio that will help create wealth and help you reach your goals. I am Muralidhar Swaminathan. Joining us today are Dhiraj Relli and Deepak Jasani of HDFC Securities. Gentlemen, welcome to the show. Thanks for joining us.
Thank you.
Dhiraj, I'll come to you first. Building a portfolio is very important for a retail investor. These days, people come in, buy a stock, throw recommendations around. People talk about multi-baggers. But building a portfolio is something that is not really paid much attention to unless somebody says, I'll give it to a fund manager. What are your thoughts?
I think building a portfolio is of paramount importance. But before one get into the building a portfolio, I think it's very important that they should understand the nitty-gritties of the equities and stock market. They should not jump the gun and start building the portfolio immediately. They should devote some more time in reading about the markets. They should follow markets for some time. They should engage with some of the experts, maybe their acquaintances who have track record. They should read newspaper, they should read related material. It's very, very important to understand the markets before started to build in the portfolio. And maybe when you are getting into the equities, it makes sense to try your hand with the experts. They may start with the mutual funds. They may start with looking at some of the schemes which are already performing. Some of the existing investors do participate in equities through the life insurance route also. But mutual fund can be a better start point for them. And once they get some hang of equities, some hang of the markets, then they should start looking at building the portfolio. And there also our suggestion is that look at the industry leaders, look at the large cap stocks to begin with, rather than going ahead with their greed for multi-baggers. I think a lot of retail investors do straight away jump to the greed and start to build large corpuses through small corpus and feel that their small amount can be multiplied and they can get huge returns. But they do not understand that it comes with the undue risk also.
Right. Very rightly pointed out that when an investor starts investing, the only thing they understand at the beginning is multi-baggers, where they don't understand the risk that comes with it. Now, if a retail investor, Dhiraj, has to look at a portfolio, apart from a mutual fund, yes, mutual fund is the best way to start off with, but as an individual, what should be the composition with regards to large caps, mid caps and small caps if an investor has to build his own portfolio?
Yeah. I think once you get into a process of building the portfolio, there is no formula which can describe for all set of customers. I don't think so. We have a one-size-fit solution for all customers, but a good combination of large cap and small cap is definitely helpful for them. As I said earlier, that to start with, they should go for large cap. I think it's important that they should understand how much diversification they need to do. So I have seen that many retail investors start to diversify as and when they get to receive more and more tips, more and more information about the market. They keep buying and keep building stocks portfolio where they are end up with 30, 40, 50 stocks, and they really have no idea why they purchase these kind of number of stocks, and this lead to sometime over diversification also. So for a new investor, I think they can start with only 5-7 stocks, and you go for the sectors which you can understand, which are more domestic economy facing stocks. Some of the sectors will have jargons which they will not understand.
Right.
So better to start with these companies and sectors which they understand, probably with the products which they buy on a day-to-day basis, use on a day-to-day basis. These kind of companies they should be first evaluating.
Right. So very clearly, let me come to Deepak. Diversification is good. Over diversification is really not good. If we have to build a core part of a portfolio, there should be some bunch of core stocks. How many and to what extent should be the core portfolios? Let's say 20%, 25% of the portfolio. And what kind of stocks would you suggest? I'm not saying recommend stocks. If you could throw some examples.
Yeah, so now a lot would depend on the age, the risk-bearing capacity, and the income dependency of the investor. So now if the investor is totally dependent on this kind of income from stocks, then he would typically have to have a large portion in the large caps. Right. Similarly, a senior citizen would have a large proportion allocated to large caps.
Right.
Uh, for a 35-year-old, probably he can afford to put a higher proportion of money into stocks, and within stocks, small and mid cap stocks. So that is how I think these three determinants will ultimately decide as to what proportion of money will go into what asset classes, and within stocks, how much into each capitalization themes.
Right.
Right.
So, Deepak very rightly pointed out that yes, depending on the age, you should look at it. But yes, the large cap should be a part of your core portfolio and not only run behind multi-baggers. Now, if someone has to decide between large caps as well, it still becomes a very difficult choice, because if you take examples, say a Maruti or a Bajaj Auto, or simultaneously from the consumer space, if you have to look at a HUL or a Britannia, and again from the banking space, if you have a HDFC Bank and an SBI, as an investor, it really becomes, it's difficult to make a choice between these kind of counters. Now, if you have to look at the large cap space between all of these kind of examples, which should be stocks which should be a part of a person's core portfolio?
Yeah, so even within large caps, picking stocks may be difficult.
Correct.
So now, first of all, you will have to shortlist as to which sectors you want to go in for, which sectors the growth cycle is just beginning, it's not at a mature stage, and within sectors also a lot will depend on what stage the company is, what is the business model of the company, which are the segments which the company is catering to. So the investor will have to sort of give a thought to all this. So whether between Maruti or Bajaj, as you said, now one is a four-wheeler exposure and the other is a two-wheeler exposure. So now the growth rates of both are different.
Correct.
Two-wheelers typically is a mature market, growing slowly. Four-wheeler is still growing quite strongly. So if you want to play safe, then probably you can go to two-wheelers. There the downside also may be limited. And if you want to be a little aggressive, probably four-wheeler will give you a better return.
Right.
Right. Okay. So now let me shift. One of the Dhiraj, 30 to 35% of the market is dominated by financial services and financial services sector. Typically, if you see even in mutual fund portfolios, you will find that 30 to 35% would be there. Given the current situation, the choice gets narrowed within the financial sector to very strong banks, your own group, HDFC Twins or IndusInd Bank or Kotak for that matter, and one or two names in the public sector banking. Now, the same set of stocks are being chased. So what should be the strategy to adopt here, and how would they go about handling this kind of a situation where you find that suddenly there is so much rush? Like in the case of HDFC Bank, the FII limit opened and within minutes it was lapped up. So this is a challenge everybody faces in building a portfolio.
I think BFSI is a very, very interesting sector, and as you rightly pointed out, it has large weightage, I think 38% in the Nifty and 40% in the Sensex. And we believe that in the near foreseeable future, this heavy weightage of BFSI will continue in the indices.
Yeah.
The interesting space is that though we get colored with our opinion on NPA menace for PSU particularly, and we think only in the BFSI space, banking companies only.
Right.
I think the choice has been widened in the recent past, because we've got now few life insurance, few general insurance companies, they've got listed. We have NBFCs and more NBFCs and HFCs are also there. So it's a now becoming more and more pure play. One or two AMCs are also listed. Few more AMCs are about to list. So I think as a space, it's a very wide space. So do not look at only banking sectors, and within the banking sector, we also, just end up comparing the PSUs and private sector banks only. I think it's the retail facing bank versus the corporate lenders. That's something we should be looking at. The banks which are doing well are the banks where they have built their portfolio in the retail asset side more. Right. And why they are able to do well? Because there is a granularity, we have lower NPAs in this sector, there's a diversification of the portfolio, right from PL to credit card to car loans and so on. So to that extent, banks which represent their represent GDP in their portfolio are the better bets for the in the current scenario, because the NPA menace is yet to over. Though we believe that 80 to 90% of the problem is addressed, and we are at the cusp of solving the NPA menace. IBC and NCLT processes are on, and they should give some resolution this year. So to that extent, a corporate lender may also look attractive in due course. But currently, I think the good quality retail lenders should be an attractive proposition.
Absolutely.
I'll tell you why. The credit penetration is still very low.
Very low, yeah.
After the demonetization and GST,
Yeah.
we have seen that more and more formalization in the economy is happening. Financialization of the saving is progress. Number of individuals filing tax returns, so they are coming into the formal credit net.
Absolutely.
And in the financialization saving side also, insurance, asset management companies, wealth management distributors, even brokers like us, stockbrokers like us, has a large place. So,
absolutely.
yep.
Yeah, no, so the point, I'll take this to Deepak, the space is very wide, as wide as the country and as diverse as the population itself of the country. Do you think, there are many stories, Capital First, Shriram Finance, would you recommend that investors look at NBFCs or small niche players within the banking so that that fits beautifully and gives them growth over a period of time? And not necessarily go with the 38% or 35% market cap that we see in the market.
Sure. Banks are all-weather investable companies, so we'll leave that aside.
Yeah.
Apart from banks, we have housing finance companies, we have gold finance companies, we have asset finance companies, largely. So now, housing finance, these three companies will, sectors or sub-sectors will perform depending on the macro conditions, and they have their own triggers. For example, housing finance companies are not in favor currently because of the rise in the interest rates across the system and possibility of NPAs out of LAP. So that subsector is underperforming. So currently, I think asset finance companies are the best ones to play out. Gold finance companies, again, a lot depends on the gold prices. So within NBFCs, you will have to sort of keep shuffling between these three subsectors, depending on the time and depending on the triggers that are existing in the system.
Right. I think on that note, we have to here slip into a short break. When we come back, we will look at how to select sectors, how to select mid and small cap stocks as part of your portfolio. Stay tuned. We'll be back in a minute.
Welcome back. You're watching our special show on how to build a portfolio. But now that we've been talking with regards to where the core portfolio is concerned, but with that, a lot of investors move towards mid-cap as well as small-cap counters. Now, the returns and the prices that we see may be illusionary because the kind of risks that we've seen, for example, with the Manpasand, Vakrangi, these are clear examples of what could have happened. Now, Deepak, coming to you as well, what's the kind of strategy as an investor that, he should say that with minimalistic risk, look at a mid-cap and a small-cap counter?
Risk, you cannot avoid risk when you are investing in small and mid-caps. So let us be clear about that, one. Secondly, we have been learning lessons in each bull run. Now, sometime back, we were told that if the promoters pledge their shares, now that company is a bit risky. So please avoid those companies.
Right.
Now, in the latest developments that we have seen, a lot of other issues have come up now, in the sense that what is the management intentions, what is the corporate governance measures they are following, what are the relationship with the auditors and such like. So selecting a small and mid cap on its own without any external help or without doing a due diligence on your own is very, very difficult. Let me put it that way. Large caps, you can take your chances. The downsides are limited even if you go wrong. Small and mid caps, if you go wrong, your capital can get eroded by 40-50%. So there, an investor has to be very, very careful. He has to do his due diligence. He has to develop his IQ, financial IQ, gradually over time. So from day zero, he need not pick up small and mid cap stocks. He has to spend some time studying the way the market operates, the way the sectors are turning up and down, and within the sectors, what kind of stock should be picked up. Broadly, which are the sectors that are doing well, and within those sectors, which are the best stocks in terms of growth at the micro level, and then going to the subjective factors like the management credibility, the governance practices and such like. So it is not very easy for a lay investors to do that on his own. So he will have to take a lot of pain, depend on mutual funds. To an extent, he can rely on the holdings of mutual funds. So that also can be a starting point for investors. But doing solely that also may be risky at times.
Right, but how important is time with regards to where investing in mid caps and small cap goes? Because if you see the performance of the mid cap and the small cap index on a YTD basis, we've seen a major erosion in the range of almost probably 10 to 15% right now. Now, do you think at current valuations, an investor could look at the mid cap and the small cap space from a longer term perspective?
Timing is important, although pundits keep saying that timing is not important in the markets. But timing in the market, timing versus time, that is the old adage. All said and done, timing, as far as a market like India is concerned, you cannot wish away the importance of timing. Current situation wise, firstly, if you have shortlisted the stocks where you want to invest, then maybe you can do a limited SIP kind of a thing. Maybe over the next 6 months, you can put 1616 or whatever is the intended amount into the stocks. So probably by that time, you will have the benefit of the averaging of the cost also. And when the markets turn up, you will get the benefit of the upside also.
Right. Now, so there lies the challenge of selecting the right stocks, which is a tough gap. Suppose, Dhiraj, let's say, what should be the principle in identifying and picking stocks and, picking them the way Deepak has suggested, do it over a period of time, have a very clear idea. Would you look at mid cap or small caps, which will be either scalable or which can survive over a period of long time and then control their market share? How would you look at it?
I think we can't paint it with one brush, all mid caps and small caps, and say that the small caps and mid caps are very risky. If you even look at currently, after the recent carnage in the mid caps and small caps, still if you look at 2 years horizon, in last 2 years, mid caps have given about 40% plus return, and probably the large caps have given 30% return. So they have outperformed, mid caps and small caps have outperformed the large cap by 10%. So to that extent, we can't say that mid caps and small caps are bad. The only limited point we are trying to make is that be very, very selective when it comes to investing in the mid cap and small caps. Do a lot of research. Take the help of brokerage houses like HDFC Securities and other good brokerage houses. Follow their research. Be more disciplined in your approach. So, you can invest in a staggered manner. Deepak has suggested in 6th installment. If you have a 5-year horizon, 10-year horizon, and you are able to identify a good mid-cap company, maybe you can stagger it over the 1 year. Maybe you can stagger it over the 2 year and do a SIP in the stock and keep entering at the different points and different price points. Right. So, at the end of the day, if business model is good and you are able to do the averaging in terms of your entry point, then you can stick to them for long term and make most out of it.
Right.
So, but when it comes to selection of stocks, I think the paramount importance is corporate governance. Are they in the industry which is growing? Whether they are gaining market share or not? How much disruption they are facing from the challengers? These are the key parameters we have to evaluate.
So Dhiraj, with the key parameters that we're looking at right now, at current levels, if you see with regards to where, valuations go, IT right now playing a catch-up rally. You have pharma where everyone is the opinion that valuations are really cheap. And with regards to, consumer durables is something which is on an uptrend. The way valuations are panning out right now, which is a sector as an investor one could actually look out for?
we mentioned that we are very bullish on the BFSI space. I think that's domestic economy facing sector, little bit repercussions on the interest rate globally. Otherwise, and that can also be passed on to the customers. So to that extent, it's a very, very interesting space, and we believe that it is under-penetrated base also. Financialization, formalization themes are also playing out in that space. Apart from that, consumption in India is a secular story. Right. And with per capita income on the rise to the $2,000, and now median per capita income also increasing, whereby the bottom of the pyramid is getting to paid more, compensation at the bottom of the pyramids are increasing, purchasing power is coming. So consumption is going to be a secular theme. Within consumption, I think discretionary consumption will outperform the GDP growth.
Right.
So that's something where, whether it is in autos, particularly two-wheeler, four-wheelers, appliances as a space. So these are interesting space. Valuations in, we've been always looking at valuations and seeing that whether FMCG are correctly valued or not, whether they are overvalued. But if you look at last 5-10 years, despite higher valuation, they've been giving very decent returns to the investors. So it is important that we look at these sectors which are more domestic economy facing, start with that, and then you can go into the complex sector like pharma and IT. IT still will be a digitization play, so one can look at IT, and they have been, going through a sluggish phase for long, and only in last 2 quarters they have performed well. That's what my view is on these sectors. Yeah.
So basically, it's a very interesting mix when it comes to IT. I think most people missed TCS and Infosys. A lot of people said that wait, and look at where TCS and where Infosys are. On that note, I think my producer is asking me to wind up. Let me thank Dhiraj, Deepak for joining us and taking the viewers through how to build your portfolio. With that, it's a wrap on this edition of Market Pulse. Up next is Trading Day with Deepanshu and Nivrita. Stay tuned.